Understanding market fluctuations. Voting machine versus weighing machine. Imagine the thrill of watching your investments soar, only to feel the crushing weight of their sudden fall. What if you could navigate these ups and downs with confidence, knowing your wealth is secure in the long run? Stay with us, and we'll reveal the secret to understanding market fluctuations and how to stay focused on intrinsic value, just like the smartest investors. Welcome to Nouveau Riche Investor. Today we delve into the timeless wisdom of Benjamin Graham's The Intelligent Investor. We'll explore the concept of the market as a voting machine in the short term and a weighing machine in the long term. This knowledge is vital for staying focused on intrinsic value and ensuring your financial success. Benjamin Graham, often called the father of value investing, introduced powerful concepts that have guided successful investors for decades. One of his most profound insights is the distinction between the market's short-term and long-term behavior. In the short term, the stock market behaves like a voting machine, tallying up votes based on popularity, emotions, and speculation. Prices can swing wildly, driven by fear and greed, rather than the true value of the underlying businesses. This can be thrilling, but also terrifying, as prices rise and fall unpredictably. Many investors get caught up in this frenzy, making decisions based on short-term trends and emotions. This is the realm of speculation, where the market's voting machine dictates the prices. However, in the long term, the stock market transforms into a weighing machine. Here, the true value of a business, its intrinsic value, is what ultimately matters. Over time, the market will accurately reflect the weight, the true worth, of a company. Understanding this concept is crucial for intelligent investing. It means focusing on the fundamentals, the company's earnings, its financial health, its competitive advantages. By analyzing these factors, you can determine the intrinsic value of a stock. Legendary investors like Warren Buffett have mastered this approach. They ignore the market's short-term fluctuations and focus on the long-term value of their investments. This discipline has made Buffett one of the wealthiest individuals in the world. Graham emphasized the importance of maintaining this focus, even when the market's voting machine creates noise and confusion. By sticking to your analysis and believing in your assessments of intrinsic value, you can weather market storms and emerge stronger. The key to successful investing is to understand and embrace the market's dual nature. In the short term, it's a voting machine, often irrational and driven by emotions. But in the long term, it's a weighing machine, accurately reflecting the intrinsic value of businesses. By focusing on intrinsic value and maintaining discipline, you can build a portfolio that withstands market fluctuations and grows steadily over time. Remember, it's not about making quick profits, but about securing lasting wealth. For a deeper dive into these principles, I highly recommend reading The Intelligent Investor. Stay tuned for more videos where we'll explore each of these concepts in detail. Until then, happy investing.